Okay, great. Thanks, Renee, and thanks everyone for tuning in. I'll just take a moment and share my screen, and then we'll do a quick kind of sound check and visual check here and make sure everything's good to go. Maybe, Renee, can you just confirm that you can hear me fine, you can see me fine, and you can also see my pointer okay?
Yes, I can see all of it.
Good to go. Okay. All right. Well, let's get into it. All right. So the question before us today is, will Alberta's boom continue? And if you've tuned in the past couple years when I've been doing this on behalf of Renee and the folks at Spire, you'll know that a few years ago, I was kind of pounding the table, as it were, on Alberta just being absurdly cheap and set to really boom for a number of years. And I think that call's been prescient. I certainly don't get all of my calls right, but I feel like that one was one that at the time, it was clear to me, and now I think it's that part has played out. The message I'm going to bring today is slightly different in that I still think the long-term prospects are excellent, but we're now at a point in the cycle where we have to confront some short-term headwinds. And that's probably going to mean that we're going to go back to a more normal housing market in Alberta and in Calgary specifically for, let's say, the next year or so. And I'll kind of give you the conclusion up front. And the conclusion is that over the longer term, fantastic long-term prospects. Over the next year, maybe a more normal market where we see price growth kind of more in that kind of 2, 3, 4, 5% range. And I think that's actually going to set us up, when the market kind of takes a bit of a breather, that's probably going to be a decent buying opportunity for those with a long-term mindset. So that's where we're at. Now let's jump into what kind of informs that view. And so we're going to start with the number one dynamic that I know everyone wants to talk about, which is interest rates. And so where are we on the interest rate cutting path? For the folks who read my work, you'll know that at the beginning of the year, I was saying that there are going to be more rate cuts than the market expects. Okay. And I even said that I think that by the end of the year, the conversation is going to change from not do we need rate cuts, but will 25 basis points at a time be enough? Okay. And let's look at where we are today. So what you're looking at, this solid line is where rates have been. So we started the year with the Bank of Canada, the policy rate at 5%, which meant we were looking at mortgages in that kind of high 6% range, mid-high 6% range. And then since then, we've had 3 consecutive quarter point or 0.25% rate cuts that today we're sitting at 4.25%. Now, the dashed lines are where the market is expecting rates to go as we look out all the way to the end of 2025. And so currently, and this changes daily, okay, so every time there's a new data release from Statistics Canada or from even down in the US, this will change. But as it stands right now, markets are expecting another 25 basis point cut later this month. And then look at this, a 50 basis point or 0.5% cut in December. And that's exactly what I was saying at the beginning of the year that we might get to. We might be looking at like a 0.5% cut towards the end of the year. And that's now being priced in. And so that should, if this is right, and markets are certainly not always right, but let's assume that this is how the interest rate landscape will evolve over the next year and a bit, then we're going to end the year at around 3.5% on the overnight rate. And we will end 2025 at about 2.75%. And so now, what I think is important there is fixed mortgage rates they're more forward-looking. They are pricing in these rate cuts already. And so even though we're going to see likely a big rate cut towards the end of the year, I'm not sure that fixed rates are going to fall a ton. We might get down into the high 3s on fixed rates, but I think where you're going to see a lot of movement is on variable. Okay. And now for anyone with specific questions around rates, of course, I would direct you to Renee and the folks at Spire who can give you all of the information around rates and how to strategize related to that. But what I would say is that fixed rates are starting to price this in. And so even as we look out towards the end of 2025, if this is right and the overnight rate's 2.75, yeah, we might see fixed rates in that kind of mid to high 3% range, which isn't a lot of downward movement from where they are currently. But variable rates will be 150 basis points or 1.5% below where they are right now. So there's something to think about. And I'm not sure how Renee is thinking about strategizing, but it looks like there could be a compelling case to be made that variable might look a little bit interesting going forward. Now, why are rates coming down? There's two reasons that I want to talk about. One is good news and one is not so good news. So let's start with the good news first. And the good news is that inflation is very much under control. In fact, we had a surprisingly soft inflation reading just this week, where inflation in Canada came in at 1.6%, which was well under where analysts had expected. They were expecting around 2%. Now, if you know the Bank of Canada, they have a target for inflation of between 1% and 3%. And so 1.6% is right in their wheelhouse. They're quite happy with that. But what I want you to notice, what's very interesting, is if we then take inflation and we split it apart and we look at how much of that is actually being driven by mortgage interest costs versus everything else, this is really surprising. Now, remember, mortgage interest costs, this is something the Bank of Canada, in a roundabout way, the Bank of Canada is causing some of the inflation that we're seeing today, because when they had to raise interest rates, one of the components of the inflation basket is mortgage interest costs, which is a weird way to think about it. And so mortgage interest costs are still accounting for over half of the actual inflation that we're seeing today. If you strip that out, inflation is only running around 0.6, 0.7%, very low. And so the Bank of Canada has lots of room to cut rates without stoking a lot of inflation. Okay, so that's the good news. Now, the less good news is that unfortunately, we're starting to get to that point where the economy is beginning to feel the effects of these high rates. And it's important to point out that interest rates, there's a saying in economics that interest rates hit with these long and variable lags. Okay, and so what that means is when the Bank of Canada hikes rates, it can take as long as 1 to 2 years before that is really felt in the economy. And the opposite is also true. When they start to cut rates, that can take a while to really filter through. So what we're seeing now, if we look at household interest payments as a percentage of disposable income, we are up at levels that we last saw in the early 1990s. So there's a lot of income being diverted towards servicing debt right now in the economy. And so where does that show up? Well, if you have to divert more of your income to servicing debt, you have less to spend on other things. And so we can see this in things like retail sales. So this is, anything that you're buying, cars, this can be furniture, this can be, yard stuff for home and garden. All of that is captured in retail sales. And if we look at it on a per capita basis, so per person, we are seeing that it is running at a negative trend. And I think the most striking visual of this is if we look at this chart on the left. So CTC is the stock ticker for Canadian Tire. Now, of course, Canadian Tire is an iconic brand. Everyone knows it. It's in just about every major city across the country. And what you're looking at here is Canadian Tire's store sales on a year-over-year trend. So look at the trend. And I'll suggest to you that if Canadian Tire is having a hard time with their store sales, it's a pretty strong indictment against the state of the Canadian consumer. Okay, and when the Canadian consumer stops spending, it hurts the economy. And so when we look at real GDP per capita, so this is how much economic activity per person is being generated, look at the trend, steeply negative on a year-over-year basis, basically at a level that historically has been consistent with recession. And so I think that we are already feeling the early stages of what at this point looks like a mild recession in Canada. Okay, now, if we zoom in specifically on you folks out in Alberta, you're not immune to this. I am very bullish on your economy. I'm very optimistic in your economy over the longer term, but you're certainly not immune to the laws of economics. And what we are seeing there is that the unemployment rate is starting to trend higher, which it is across the entire country. But you got as low as about 5% unemployment, and now we're up to about 7.5%. So you've seen about a 2.5% increase in the unemployment rate in Alberta over the last year or so. And you're starting to see that in some of the data points that would suggest that consumers are starting to hurt at the margins. So, for example, the chart on the right is showing consumer insolvencies on a per capita basis. So you have to control for the fact that your population is much higher. So it would be misleading if I just showed you a chart showing consumer insolvencies. So if we normalize it for the population, this is what the trend looks like. Now, I should be clear on what we're looking at. When I say consumer insolvencies, most folks would understand the term bankruptcy. Okay, that's one form of consumer insolvency. The second is what are called proposals, a consumer proposal. And that's where someone has some form of debt and they make an arrangement with their creditor. They're like, look, we can't pay you, but I'll pay you 30 cents on the dollar. Okay. And it's not quite as bad as bankruptcy, but it's kind of along the same line. And so both bankruptcy and proposals are forms of consumer insolvencies. You can see that consumer insolvencies in Alberta are trending higher. They're basically back to levels we saw before the onset of the pandemic, but interestingly, above the levels we saw during the financial crisis. So there are some signs that Alberta's consumers starting to feel the impact of these high rates. Now that's the bad news. I want to show you some glimmers of hope. I wanted to press everybody. It's not all bad news out there. In fact, when we look at something like consumer confidence, we've seen now a pretty sharp increase off of these lows in the last 6 or 8 months. Now this matters especially for home sales, because when you're talking about the biggest purchase of most people's lives, you have to have a lot of confidence. If people don't feel confident about their finances or about their job prospects, that's where they'll often kind of move to the sidelines and they won't engage in home buying. And so we've seen a lot of that now, less so in Alberta, but in the rest of the country, especially Ontario and BC, we've seen very low confidence, very low home sales. But in the last few months, we're starting to see those sales perk up in line with rising consumer confidence. So there's maybe some glimmers that the economy might be improving at the margins if consumers are feeling a little more optimistic. The other thing I'd point out is the OECD, which is a kind of an international economic consortium of governments that share data, and they have what's called a composite leading indicator. Now, if you know a little bit about economics, you'll know that there's certain data sets that tell us where the economy has been in the past, right? And then there's other data points that do a better job of telling us where it's going in the future. And we call those leading indicators. And so the OECD produces leading indicators for Canada every month. And the idea here is if it's at 100, it's kind of like the economy is more or less going to be flat, kind of 6 to 12 months down the road. If it's below 100, it means you've got some pressure on the economy, and above 100, it means the economy is really booming. And so you can see that for most of 2023 and 2024, it was below 100, and now it's finally clawed its way back up to 100. And if it gets much above that, it's a good indication that we're actually going to see decent growth, again, like towards the latter half of 2025. So there's some reason for optimism there for sure. But the reality is, as of right now, these high interest rates are starting to hurt consumers. Now, when we consider that consumers are starting to hurt, the economy is starting to hurt, and inflation is very low, that is what is informing the Bank of Canada's decision to cut rates. And that is why you're starting to see expectations for not just a normal interest rate cut, but like that 0.5% cut at potentially the December meeting. We may even see it in October. The market's kind of split on whether we'll see it in October, but it looks like they're quite set on this idea that it's coming in December. Okay, so what does all of this mean specifically for Calgary and Alberta's housing market? Now, remember, I said I'm still very optimistic, but in the near term, you have a few what I would call headwinds. Okay, and that's certainly not a bad market, but just some challenges that are going to kind of keep a lid on things. And so, what do I mean by that? The first that I point out is I want you to notice that home sales are still at very strong levels. Okay, that's true in Calgary, although you've seen there's a little bit of a downward drift in home sales. This is seasonally adjusted home sales for Calgary. If you're not familiar with that term, seasonally adjusted, you're going to see that throughout some of the data sets or some of my charts here. The idea of seasonal adjustments is just that, for you folks in the real estate space, you know that there's more home sales in May and June than there are in December. And so you can't compare one month to the next. We have to adjust for that normal seasonal variation. So economists do that. It's well understood. So anytime you see that term seasonally adjusted, that's what we're doing. We're taking out those seasonal wiggles so that we can compare one month to the next. So this is the trend in home sales. You can see that, of course, that huge boom coming out of COVID pulled back a little, and here we are, still very elevated. But you can see, you're starting to see that consumers are maybe struggling a bit with these high rates, a little bit at the margins. Less so in Edmonton, by the way. Still very strong levels of sales. I'm not concerned about demand. I actually think you folks are going to be quite busy. You're going to have lots of sales. There's going to be lots of demand. That's not what has me concerned. What I'm a little bit more concerned about, and I don't want to overstate it, but I'm a bit concerned about the trends that we're seeing with inventory. And so let's look first at Calgary on the left. This is active listings at any point in time. Each of these dots is any 1 month. You can see along the bottom axis. And each colored line represents a different year. And so you can see that we entered the year with inventory levels, so active listings on the MLS, at basically 20-year lows in Calgary. And from January to September, we have seen a 150% increase in the number of homes listed for sale. Now that happens every year. Okay, you can see in the charts, there's always more inventory in September than there is in January every year. But that increase, that 150% increase, is the largest increase we've seen since 2006. So we're seeing a lot more inventory coming online, which in one sense is good. Because if you've had clients that were trying to buy a home, especially in 2023, you can see how low inventory was in 2023, beginning of 2024, there was just nothing to buy. Okay, and so having a bit more inventory in the market is not a bad thing. All right, but when it accumulates this quickly, you kind of look at it, you go, okay, well, that's interesting. Let's keep an eye on that. Now, notice we're not really seeing that same dynamic in Edmonton. We still have very low inventory levels in Edmonton. So we're up 50% year over year for inventory in Calgary in September. We're down 20% year over year in Edmonton. Okay, interesting divergence in those trends. So that's what I'm really watching, is what's happening with inventory. And, I think this is probably going to continue to increase, probably, into 2025, the first half of 2025. Now we'll talk about why that is. But before we get to that, let's note that we've had a tremendous run in house prices in Calgary specifically. So my call, when I really got excited about Calgary back in 2021, I said that I think Calgary would dramatically outperform the Canadian average. And it has certainly done that. But to visualize how much it's outperformed, chart on the right shows you the 3-year house price change across various points across the country. In Canada, we've only seen house prices up about 2% in the last 3 years. So if you adjust that for inflation, you're not even keeping up with inflation nationally over the last 3 years. But that really kind of hides the regional trends. BC is up about 7%. Ontario is only up like 1.5% over the last 3 years. Really not a great time to be an investor in Ontario. But look at what you folks are seeing. Alberta overall up 22, 23%. Calgary specifically up 28% over the last 3 years. So you've had about a 25% percentage point outperformance over the Canadian average. So pretty remarkable, and very much in line with the expectation when I started writing about this in 2021. Now, the problem with that is when you have a period of price appreciation as much as we've seen, it's not uncommon that you kind of go through a period where the market has to catch its breath a little bit. Now, why is that? The reason is that when you have such strong price appreciation, you tend to attract some form of speculation. And when you see a lot of speculators enter a market, it's a good sign that the market's going to have to take a bit of a breather, that it maybe got a little bit too hot. So where do we see evidence of this? This is interesting data from the Bank of Canada. This is the share of homes in Calgary that were purchased and then subsequently flipped within a 6-month period. And you can see that we're at levels that we have not seen in the past decade. Okay, so there's some sign there that maybe we've attracted some speculation. Some hot money has come into the market. And usually when you see hot money come into a market, it means it's due to take a bit of a pause. Okay. Now we also see this in condo sales. And in my view on condo sales, and nothing wrong with condo sales, nothing wrong with condos. But if you think about where people tend to invest, especially if they're not locals, what do they tend to buy? It tends to be condos. And what we've seen, I believe, is that as the housing markets in Toronto and Vancouver have gotten very soft, and especially the condo markets in those metros, I think we've seen a number of investors have left the Toronto market and are now focusing in on Calgary. That's not a bad thing over the longer term, but it does mean that there's a little bit more volatility in the near term when you bring a lot of investors in. Okay. Now, where do we see this? We see basically condo sales in Calgary for the month of September. You can see this dramatic ramp up. It has basically doubled between 2020 and 2023, 2021 and 2023. So over a 2-year period, basically doubled. And then as of this current year, we see a sharp pullback. I think that's the first sign that maybe investors are starting to struggle with these high rates, and that adds a bit of volatility to sales. Okay. So anytime you have a run up in prices like this, it tends to attract speculation. It usually sets up for a bit of a consolidation period where the market has to catch its breath before it resumes. And I think that's kind of what we're looking at in the near term. The other thing that's important, very important for Calgary, is when you have this much demand from investors, it means that developers can pre-sell a lot of inventory. And generally, the developers in Calgary specifically have been very good historically at bringing new supply to market to help meet that increased demand. And so where do we see that? Well, look at what's under construction across Calgary. So there's the chart on the left. These are dwellings under construction at any point in time. You can see prior cycles. There's 2006. There's 2015, 2016, and here we are currently. Now, what's different this time, and what I would really point to, is you kind of have to pull this apart and look at the components. Okay, so if we pulled dwellings under construction and we looked at the 3 components that make that up, you have single family, you have condos, and you have rental units. Okay, and what's different this time, and I know this chart on the right is a bit busy, it's kind of hard to read, but notice the orange line. These are rental units under construction. Big boom in rental units. Okay. Now, if you can kind of squint, you can kind of see what's going on. The gray is condo. It's again, it's a bit busy, and I apologize for that. We're not back up to the levels of condo construction that we saw in 2015 or in 2006, 2 prior cycles, but we're getting up there. Single family is the blue line, and I know it's hard to read, but we're basically back to levels we saw in 2006. So there's signs to me that developers are now starting to meet that increased demand. And normally when you see this, you can kind of set your watch and it'll start showing up in resale inventory, because these will complete. They're in the construction pipeline. Some of those will enter the resale market, and you'll have a better supplied resale market. Okay, and just to go back, I think that's part of what we're seeing right here, why this inventory is trending higher, is you're now beginning to see developers completing units, and those units either hitting the market as new supply, or it's people who are going to move into those units and they have to sell their existing home, and that's showing up as resale supply. And so based on what's in the construction pipeline, I think this is going to continue to trend a little bit higher through 2025. Okay. So just to push on, one thing I also want to comment on is what's happening specific to the rental market. So if I go back for a moment, and just again, I want to highlight this orange line is rental units under construction at any point in time. Okay. Now, if we look at isolating that, so that this is taking that orange line and isolating it so you can see it a little more clearly. These are rental units this is actually across all of Alberta. And you can see the trend. It's very high. Now, that's a good thing, because if you look on the right, we have seen tremendous rental growth. Okay. This is the rented accommodation subindex for Alberta. And you can see it is showing that rents are up kind of 12% year over year, the strongest rate of appreciation since the early 1980s. So we need this rental supply. Okay, so that's good. If I put a bug in your ear, I just want you to think about one thing, because I do think there's well, I'll just say it. I think that the rental market will be much more normal next year at this time, and even the year after. Okay. I think we'll go back to a period of time where rents are going to be growing at kind of 1, 2, 3, 4% a year, as opposed to, 12, 13, 14, 15% a year. Now, why is that? Remember, we've got a lot of units coming up in the construction pipeline. But let's talk about what's created this rental boom in the first place. So, chart on the left is Alberta's population growth. I am going to return to this because it's one of the reasons I think over the longer term, Alberta is going to do very well. But for the time being, I want you to notice Alberta has added almost 150,000 people in the past year. And the majority of those have settled in Calgary specifically. But within that, I want you to notice what's driving that boom. The blue line is permanent residents and interprovincial migration. So this is people moving from other provinces as well as people coming here from other countries. That's the blue line. The orange line is non-permanent residents. Okay, and so what are non-permanent residents? These are international students and these are temporary workers. And you'll see that most of the crazy increase in population growth in Alberta over the last couple of years has been due to non-permanent residents. Now, why is that important? Non-permanent residents, if you think about international students, temporary workers, they're all renters. They're all renters. And so we've been adding almost 100,000 to Alberta on an annual basis for the last 2 years. So of course the rental market's going to go crazy, right? Why wouldn't it? And this is true across the country. This is not specific to Alberta, but it's been more pronounced in Alberta. You've seen a much stronger increase in rents in Alberta than you have in other parts of the country. But the question now is this going to continue? And one thing I would point to is if you look over the last 6 months, we have seen a string of announcements from the federal government around tightening restrictions around temporary workers. We've seen a number of announcements around tightening up international students. And the government's actually gone so far as to say that they want to reduce the number of non-permanent residents in the country. So I don't have a chart on it here, but I've written about it in my publications. Right now, non-permanent residents in Canada are 7% of the total Canadian population, 3 million. 3 million people in the country that are here on a temporary basis, okay? That is off the charts historically. We've never seen anything like it. And the federal government has come out and said, we actually want to get that percentage from 7% down to 5% over 3 years. Now, if they're serious about that, and there's a lot of questions about how serious they are, but let's just assume that they're serious about that, then that's going to mean they have to reduce the number of temporary residents in the country by 250,000 annually for the next 3 years. So in other words, this orange line is going to go from being very positive to being slightly negative. So it's going to pull down total population growth a little bit. Okay, so population growth, I think in a year, maybe a year and a half, you'll see population growth in Alberta go from 150,000 currently to probably back down to the long-term norm around kind of 50, 60,000. So that's going to be a big slowdown in growth if the feds actually do that. So again, remember what's in the construction pipeline. We have a record amount or near a record amount of rental units coming. And I think the feds are serious about trying to tighten up on the growth in the non-permanent resident cohort. And so when you combine those two things, I think we're going to go from a situation where rents are growing at kind of 10, 12% to a year and a half from now, they'll be back down to that kind of 1, 2, 3%, which is, frankly, let's be honest, that's not a bad thing, right? You don't want this crazy rental market like we've seen over the last year or two. But what it does mean is if you're buying investment properties today and you're kind of filling out your return projections, I would not be penciling in 10 or 20% rental growth over the next couple of years. Okay, I'd be penciling in 2, 3, 4% and see if you can make the numbers work with those types of growth rates. Okay, so just a slightly different environment, not a disaster, but just something to be mindful of that we're probably going back to a more normal rental market. So what does this mean? I guess the main point is Alberta, the housing market, especially Calgary, ran very hot for 3 years. Okay, it was severely undervalued for a number of years. We've seen a dramatic increase, and that's attracted some speculation. And when you have that sort of speculation, that in turn has led to strong construction activity. The economy is now cooling. We're seeing that sales are starting to stall out a little bit. They're still at very high levels, but they're probably not going to keep growing from here. And more importantly, we're seeing resale inventory is building. So we're finally seeing some supply coming to market. And what that tells us is the boom is going to have to pause for a bit while this new supply is absorbed. And so I think that as we look forward to 2025, we're going to go from seeing price appreciation of kind of that, 10, 12% range to probably more like, again, 1, 2, 3% growth for the next year or so. That's not a disaster, but it just means it's a more normal market. It's gonna feel like you've gone from driving, when you drive like 120 on the highway for a period of time, then you go through a construction zone and you got to drop down to like, 60 or 70. Feels like you're standing still, right? And I think that's probably what we're gonna have happen. You've just been so used to such a crazy hot market that I think in the next year, when we go back to a more normal market, it might feel slow, but it's not going to be slow. It's just going to be normal. Okay. We have seen a lot of rental construction happening, and there's going to be a lot of completions next year. Just be mindful of this risk. If the feds do manage to slow down temporary resident growth as they promised, we should expect the growth in rents will cool. Okay. So in sum, I'm not projecting a down market. I'm not projecting a crash. I'm not projecting any of that. I'm telling you it's going to be a normal market. And for you folks in Calgary, it's been a number of years since you've experienced a normal market. And I think that's what you're going to have in 2025. Okay. So I hope that's not bad news. That's just a reality check. That's the short-term headwinds. Now let's transition and let's talk about the long-term opportunities. And here's where I'm still excited about Alberta broadly, but especially Calgary. So it's important to note that even though Calgary has household incomes that are substantially above the national average, the affordability is still very, very good. Okay. And so what you're looking at here is an estimate of how much would your monthly mortgage payment be if you bought the typical home, the kind of the national price, and if you had to finance it at 80% loan to value and get kind of an average mortgage rate. Nationally, you'd be looking at about a $3,000 monthly mortgage payment. Okay, it's substantially lower in Calgary, and it's much lower in Edmonton. And so from an affordability perspective, that's attractive. And it's especially attractive considering that incomes are higher in Calgary and Edmonton than nationally. And so if we look at mortgage payments, take these kind of mortgage payments and then look at it relative to income, you'll see that BC is still exceptionally unaffordable relative to norms over the last 20 years. Ontario, same thing, although getting better at the margin. So I think we've seen the worst of the affordability crisis in BC and Ontario. There's the Canadian average in black, right? And look at Alberta, just way lower. And so there's still a significant affordability arbitrage here. And I also want you to notice that monthly payments as a share of income is way below where it was in 2005, 2006, when you had that kind of big run up in prices and then a big correction. Okay, we're still nowhere near that. So there's a lot of room for affordability to attract people to the area because of that relative affordability. Now, I said back in 2021 that I thought, so first of all, let me explain what you're looking at. This is Calgary and Edmonton's house price index relative to the national house price index. So in other words, is Calgary and Edmonton, are they trading at a premium to the national price, or are they trading at a discount? So when it's above zero, it's telling you that Calgary and Edmonton are trading at a premium to the national price, and what's below, it's trading at a discount. Now, notice that for Calgary, through most of the 2000s, Calgary actually traded at a premium to the national average. So if the national average house price was $300,000 going way back, Calgary would be like $330,000, $350,000, right? Today, Calgary and Edmonton still trade at massive discounts to the national house price index. And when I got really bullish on Calgary was right when it was starting to get down to that kind of historical cheapness. Calgary has made up a lot of ground, right? Because of that outperformance that we saw. Edmonton's still near historical lows. It's historically cheap. relative to the national average. And I actually said that I think that before this cycle is over, so in the next few years, even though I think prices in Calgary might be kind of only up 2, 3, 4, 5% next year, beyond that, you look out over the next 3, 4, 5 years, I think Calgary is going to trade back at a premium to the national average. I think that's where we're going. Okay, and so there's still plenty of outperformance in Calgary relative to the national. But I think in the near term, probably next year, Edmonton's probably going to be the stronger price performer. So still a lot of affordability relative to the national average. And where we see this is in the population. Now, remember, I just showed you that a lot of the population growth we've seen is from temporary residents, and the feds are now very keen at kind of slowing that growth. But we had almost 4.5% population growth last quarter. That's crazy. So even if you got this back down to 2.5%, which is kind of still above the long-term norm, that's still big numbers in Alberta. And you're still going to be leading the country this time next year on population growth. Now, why is that? That's because we're still seeing an incredible flow of people out of other provinces into Alberta. So what you're looking at here is net interprovincial migration. So this is not looking at immigration. This is looking at how Canadians are moving between provinces. And so you can see that there is an exodus out of the expensive, high cost of living areas like BC and especially Ontario, and into the more reasonably priced areas like Atlantic Canada and especially Alberta. Huge boom in Alberta. So we are attracting, when I say we, you folks, your province is attracting about 45,000 people every year from other parts of the country, simply because of the attractive affordability, I believe, largely because of the attractive affordability situation. There's no reason to think that's going to change. Okay, I just showed you, you're still trading at a massive discount to the national. That's going to continue to attract people. So, so why I remain long-term bullish? I showed you the affordability arbitrage. I think that's going to continue to drive population from the expensive areas into the more affordable areas like Alberta. Your Calgary will continue to be a recipient of that. But in addition to that, when I look at like more structurally, why I think over the next 5 to 10 years, Alberta is going to do so well, it's important to point out Alberta still has the youngest labor force in the country and a very highly educated labor force. So young labor force means lots of productivity, means lots of innovation, highly educated. You're going to see productivity boom. You're going to see standard of living increase, GDP per capita increase. That's great. That's what you want to see. Okay. Taxes and startup costs are still very low relative to other parts of the country. I know folks out there probably aren't happy with taxes as is the case everywhere in the country, but relative to other provinces, your taxes are still attractive and your startup costs are so low. You still can lease office space and industrial space much cheaper than you can in other parts of the country. That's very attractive to people trying to start up businesses. When I look at the economy out in Alberta, you're seeing that it is slowly diversifying away from some of the more cyclical industries like oil and gas. And you are seeing this early signs of a boom in some of the more tech kind of next generation industries. And I think that's related to this low startup cost and this young educated workforce. There's no reason to think that's going to change, right? If you're a young person today and you want to start up a business, you can go and attract fantastic talent in Calgary. And part of the appeal is that you don't have to pay such crazy prices to get into the housing market like you would in Toronto or Vancouver. And so you're going to continue to see, I believe, a strong new business culture, an emphasis on next generation businesses. We're seeing that already starting, and that's very good for the long term. And I think all of that is tied up to this reality that housing is still relatively affordable. I know it may not feel like it because the prices have risen so much in Calgary relative to what it was 3 years ago even. But you have to look at it on the national situation. How is it compared to the Torontos, the Southern Ontarios, the BCs of the world? You still look great. And so you're going to continue to track those inflows and especially inflows of young, educated workers. And to me, that's the number one thing that over the longer term is going to continue to make Alberta a really attractive investment opportunity. And so the key takeaway, if I were to summarize it, is, yeah, we might have a more normal market in 2025. If you are long-term minded and you see a little bit of softness in that market, that's probably a good buying opportunity, because I don't think it's going to last. I'm still very bullish on the long term. So I'm going to leave it there. I'll turn it back over to Renee. I hope that was you folks know me. I don't sugarcoat things. I've been on here before pounding the table, being like, this is a crazy good opportunity. Here I am, a couple years later, being like, I still think it's good, but we got to be mindful of the near term. So I hope that's helpful. And you're going to get an honest opinion of me one way or the other, from me one way or the other. But I'll stop there and I'll turn it back over to Renee.
Awesome. Thank you so much, Ben. That's amazing. I've got that chat open. So if anyone has any questions that you guys want me to specifically address, please drop them into that chat. I think you covered a lot of it. I mean, who's just going to jump off this call and go start looking for real estate opportunities? I think, I'm curious about why you think Edmonton tracks behind Calgary. Like, why didn't Edmonton see the same boom that Calgary did over the last 3 years?
Yeah, it's a great question. The nature of Edmonton is that it's naturally less cyclical, because it's more skewed towards government employment than it is towards those cyclical kind of oil and gas industries. And so historically, it has not seen the same booms and also the same busts that we've seen in Calgary, if we're being honest. But what I think happened is, I really think that I think Calgary really popped up on investors' radars in kind of 2022, 2023, especially as people want Canadians. Look, we know Canadians love real estate. It has not been a fun ride if you're a real estate investor in Toronto, for example. It's been hard to make money over the last couple of years. And so if you've exited that market, you still want to deploy capital. So where do you go? Calgary becomes very interesting, right? Now, what that's meant is prices have run up a lot, but also development activities run up a lot. And one of the things that I've flagged for my clients through Edge Analytics is that when I look at one of the things I like to find when I try to think about which markets are going to really rip higher over the next few years, one of the things you want to look for is like low resale inventory, low development, like construction activity, right? And those two things, because that tells you that developers have not yet started to respond to that tight inventory market. And so that was the case in Calgary 2 years ago. It's still the case in Edmonton today. So when I look forward over the next year, I think Edmonton's going to catch up. I think Edmonton, I've been saying for a while, I think Edmonton's going to take the crown from Calgary for being the best performing market in the country over the next year. But I'm not concerned over the longer term for Calgary. I just think your market is due for a pause and kind of, adjust to the crazy couple years that we've seen.
Okay. I just see a question. It says, what is the ratio in residential price between Calgary and Edmonton? I think that was shown really well in one of your graphs, because Calgary is traditionally more expensive, right? That's the question was, which city is historically more expensive, but it's Calgary that is traditionally led Edmonton. Is that correct based on that?
Yeah, graph? That's right. So I'm eyeballing the chart, and I'll send this. This is in the deck that I'll send Renee, and you're free to circulate this. But Edmonton, if you look at benchmark house prices, which the kind of the house price index, so it tries to approximate the typical home being sold. Edmonton's around 400,000. Calgary now you're up kind of towards getting close to 600,000. So decent premium on Calgary relative to Edmonton.
Definitely. One thing that you didn't touch on today, Ben, and tell me if this is maybe too much of a deep dive, but do you think that all of the new mortgage rule changes that have been announced are actually going to make any substantial difference in demand across the country, like allowing 30-year amortizations for first-time home buyers on any property type, increasing our default insured mortgage price to $1.5 million so you can buy, a higher price property? Maybe specifically as it relates to Alberta, because I think that's probably a bit more of it probably makes more of a difference, in Ontario and BC than it does here.
Yeah, definitely. So, okay, a couple thoughts on that. The 30-year amortization, I think, great policy. It's worked well in the US forever. It's worked well in uninsured in Canada forever. There's no reason to restrict insureds to 25-year amortization. In terms of what that does, it on average, you're looking at reducing your monthly payments kind of 7-8% when you go out to 30 years versus 25. So yeah, that's going to help at the margins. It's going to help a lot more, as you said, in the Ontarios and the BCs where those buyers need every last dollar of purchasing power. It's less impactful in places like Calgary and Edmonton where the affordability picture is not as strained. So it's going to help you guys. It's going to help Ontario and BC a lot more. In terms of bumping the insurance cap up to 1.5 million, I mean, let's be honest. I get the rationale if you're trying to buy into the 416, like the city of Toronto. If you're trying to buy into Vancouver, yeah, 1.5% or 1.5 million, you're an entry level home. In Calgary and Edmonton, 1.5 million today is still a hell of a lot of home. It's not a starter home. And
Yeah.
so, you know, if we look at the way that the US has handled mortgage insurance, they have regional caps, which kind of makes sense, right? Like, so if for high cost of living areas, they would say your insurance limit is X, but for lower cost of areas, it's lower.
Mhm.
I think what you're going to see going forward is if we get a change in government, there's a lot of moving parts there, but let's play through it. You know, I've looked at how the Conservatives have how they've questioned the CMHC's leadership in, for example, the Standing Committee of Finance. I've looked at how, for example, Poilievre has specifically questioned them, the sort of interaction they've had. It's pretty clear that they favor a slightly tighter approach on mortgage insurance. And so I'm not sure that these rule changes, the 1.5 million cap, is going to survive the next election. I got to be honest. And I think from the perspective of like what makes sense, 1.5 million insurance cap in Calgary, like it's just hard to suggest that that's a first time buyer type program.
Mhm.
You know what I mean? So look, that all of that said, here's the key takeaway from that. The key takeaway is that the government recognizes that the housing industry has been really hurting, and they're now starting to signal that they will do what they can to support it and kind of put a floor under it and reinvigorate demand. So if you're in the industry, for the mortgage folks, for the real estate folks on the call, that's good. You're seeing out of Ottawa a recognition that the industry needs help, and that help is starting to come.
Yeah. Yeah. I know that when I kind of surveyed some of my colleagues, something that came out of it was that, like in Calgary, at a $1.5 million home, that's often quite a custom home too. So when I reached out to some builders, they were saying like, we want 20% deposit to build that home. Like that's a massive risk
Yeah,
for us. So like for us, it really doesn't even matter. Like we want to know
totally.
that the buyer has that kind of skin in the game before we're customizing a home at that level. So certainly in Alberta, I think we'll see some of that where like the builders aren't interested in building unless somebody had 20% at that mark. So I thought that was interesting as well.
And actually, let me ask you, Renee, because you'd know better than I would, but I know in the Torontos and Vancouvers of the world, you get this crazy game where it's like, if you're priced at 999,000, you're going to be very busy. But if you're priced at like $1,001,001, it's like, it's
Yeah.
dramatically less busy. So you have this noticeable cutoff right at that million mark. Now, do you
Mhm.
guys have that dynamic in Calgary?
A little bit, but just a little less so, right? Like just with property prices being a little bit less. Like I think, there's obviously, many realtors on this call and they could maybe talk to it better than I could, but over $1 million, yes, it matters, but like there's still gorgeous homes available at 700, 800,
Yeah.
900, right? So it's not as tight as you would see, in certainly like 1,050,000 versus 999,999, like probably in this kind of a market, you're probably better off to list at 999,999, but
Yeah.
it's not as drastic, I don't think, as you would see in the larger centers.
Yeah, and so I think that tells us that increasing that cap is going to move the needle a lot more in the Torontos and Vancouvers, because you really do see that's like a real game people play. And it used to be that like if you could bid, if you had a bidding war, if something was priced at 990, let's say, if you
Mhm.
could bid 1,050,000, you
Right.
know that eliminates 90% of the people buying, right? Just the
Right.
moment you're above that million. So that tells you how tight so makes a lot of sense in Toronto, Vancouver. Man, 1.5 million cap in Calgary is crazy to me.
I'm hoping actually, just like for everyone else on the call too, that it might blow apart some of the sliding scale expectations at the lenders. Like even when you have 20% down, sometimes when you get into $1.5 million, they're expecting a bit more than 20% down.
Mm,
And so because the lenders are going to have to look at that and they're going to be doing insured business up to $1.5 million, it might blow apart some of that to just even have a bit more flexibility with just 20% down at 1.5
That's a great point.
million.
Yeah,
So
that's a great
I'm
point.
kind of hoping that it just sort of blows apart some of the sliding scale stuff that we see, especially, as you're moving maybe outside of Calgary into like sort of more of the communities, smaller communities outside of Calgary. We sometimes see a little bit of a sliding scale trouble or sliding scale problems there. So I'm hoping that it just,
Yeah,
invigorates the market a little bit, even with the 20% down.
that's a
But
great point.
yeah, so that would be nice to see. I see a question here, and it says, for Alberta diversifying its economy away from oil and gas, besides tech, what other industries are you feeling that are emerging, or that are you seeing that are emerging in Alberta?
Well, it's broadly across. I'd have to go back and do a deeper dive, but I know that even when you look at some of the commercial, industrial, like just your old school manufacturing, you're starting to see it come back there too, because the reality is that because you went through such a period of overbuilding on everything related to commercial in 2015, 2016, that it's still relatively cheap to acquire the leasing space, acquire the facilities, again, relative to what it would be in Southern Ontario, right? So you're seeing that, and I think just the recognition that you have access to a pool of young labor, right? Because that's one of the other issues that you're seeing is like, yeah, you could start a manufacturing or distribution center in Quebec, but the labor force is just so much older, right? You're just surrounded by a bunch of seniors. It's like you got, how are you going to staff it, right? It's like that's a real challenge for some places. So I'm seeing it across industries, including in the old kind of traditional manufacturing space. So I think that's broadly the areas that are going to do very well. But what I'm most excited about is the early signs of kind of like a that next generation tech stuff. And I've got a good friend that's on a kind of a tech incubator in Calgary, and I mean, he's just like, so excited about what he's seeing. He's just like, you're seeing a real boom, and it makes sense again, because, if you're trying to attract the best and the brightest, it's a lot easier to attract them when house prices are more affordable, right? Versus paying 3 or 4 times that in say a Toronto for the same wages, right?
Yeah, and for the same jobs too. Like
Yeah.
often, like it's been so interesting to just see, we've done so many mortgages for people that have kept their position because they were working from home in Vancouver. Why would you work from home in Vancouver when you can work from home in Calgary? I mean, like just the upgrade in living space and lifestyle is super, super significant, right?
Yeah,
Um,
it's true. And one of the things that I think I didn't include it on the slide deck, but like, um, I don't know if people realize this. Do you know that Calgary is the sunniest city in Canada? It is. It does the most sunlight of any major city in Canada. So Calgary sometimes gets a knock for like some cold weather in the winter, but at least you guys get real winters. Like you get real winters where you can do stuff, as opposed to being like, -2 and muddy and kind of just wet. You guys get real winters. You get beautiful sun. Like so I just think all of that recreate those recreational opportunities, the weather. Look, winters suck everywhere in Canada, but at least you get sun and you get
yeah,
real winters out there. You know what I mean? I just feel like it's kind of that dynamic is underappreciated.
yeah, definitely. I have one more question. Something that I've seen is a lot of the builders, whether they're custom builders or production builders, I'm seeing just like a massive mindset shift in these builders. And we saw this actually at our event last year. We had a builder panel, and they talked to a move to building purpose-built rentals, and building, like holding assets within these building companies. And my office is on the west side of Calgary. Like there's massive, massive Truman developments going up across the street from me, thousands and thousands of doors. And, I'm seeing some of these buildings being kept for rental. They are not for sale. And I'm wondering if you're seeing that across the country. And just for me, it makes me think like, I've been buying real estate since I was 23, and, wanted to be long real estate forever as just, sort of like a ma and pa, like, I don't know, seems like rich people own real estate. Maybe that's what I should do kind of thing, right? Like just on a
Mhm.
small residential scale. But it seems like we've just seen this like huge shift to owning actual like residential rental property by these massive builders and developers. Are you seeing that across the country? Why are we seeing that? Can you talk to it a little bit?
Yeah, absolutely. So I think one of the big reasons, one of the big changes we've seen in the last few years is the CMHC's MLI Select program, which funds both the construction, but also the acquisition of multifamily
Yeah.
at just these incredibly low rates has been such a boom to rental construction. And we're seeing that right across the country. Now, not to get too into the weeds, but earlier this year, CMHC tightened up the qualifications to qualify for the kind of the best funding, and it's going to disproportionately hurt Ontario and BC, and less so for you folks in Alberta. And so I could see a scenario where you start to see rental construction slow a lot in Alberta and BC, but still be quite strong out in Calgary and other parts of the country. So I think that's the change in financing and the expansion in not to get too in the weeds, but we had like the government of Canada came out and announced a big expansion in Canada mortgage bond issuances. A lot of that is helping to finance. It gives a lot of runway, a lot of availability to finance development, and specifically rental construction development. It was main priority for CMHC, and it's one of the things where they've been very successful at incentivizing new construction. Now, it's also helped that we've had such an incredible boom in that temporary resident cohort, that rental markets have been so strong for so long. And again, I think that's going to change. Like, I think we're going back to a more normal rental market. But those two things have been really what's driven this rental construction boom.
Yeah. And so everything that I heard you say today about rentals, because I had this conversation just a few times this week with different people, even on this call. And, I owned rentals in 2014 where like we would put up a Kijiji ad for a single family home in Calgary, and you'd have 50 people lined up at the door in 30 minutes. It was unbelievable. And then like in a heartbeat, those single family homes went from renting at like 2,400 to 1,800 2 years later. Like it was unbelievable. And you get 4 people from a really good ad with professional photos. And so you're not sensing any of that. Hey, like you just think it's going to be normalized growth. You don't think that there's going to be an actual pullback in the rents that we're achieving?
I hope not. I don't think so. You got to remember 2015 was unique because what happened was you had such a dramatic slowdown in oil, like specifically like CapEx, like so that all the projects were effectively halted at once. And you had an outflow of workers out of oil and gas. And they basically, like, I'm not kidding, they basically upped, and they all moved to Toronto to swing hammers and condos. Like, I'm not even making that up. Like, you can literally see that. Yeah, like you could see it. Like the rental market all of a sudden softened dramatically in Calgary and went nuts in Toronto exactly. And you could see this flow of people. So that chart that I showed about interprovincial migration, everyone moving to Alberta, it was the other way around in 2015. You saw people leaving Alberta. There's none of those dynamics right now that I see. And I don't see any reason to, because again, like that was such a hard stop in the oil sector. They just like turned the lights off overnight in the oil sector. And when you look at oil CapEx, like actual spending on big developments, it's incredibly low. It's like, I mean, I've pulled the numbers. It's like half of what it was in 2015 today. So it's not like there's nothing to shut off, right? Like there's no massive new developments underway in the oil. If anything, it's like the spending is depressed. So I don't know what would cause the economy to just suddenly slow down that quickly out there. I don't think it's likely. But that said, there's a lot of construction activity in rentals, right?
Yeah.
And so I do think you're going to go from that crazy tight period we've seen in the last 2 years to just being something that's like a little more 1%, 2%, 3% rental growth. Knock on wood. I think that's where we're going. I don't see declines, but we'll see.
Okay. All right. So there's one last question. Can I ask it? I know we're 2 minutes over.
Yeah, no, it's fine.
Chris, I don't know. This is a hard one. Given the retracement of lumber prices post-COVID, as well as the recent rise in unemployment, how much wood would a woodchuck chuck a woodchuck could chuck wood? I don't know, Chris. I don't know. You're gonna have to give us something else.
That's a good one.
Anyone else have anything else they want to ask? Okay, well, this was hugely helpful to me. Thanks so much, Ben. I'm super excited about what's to come in Alberta. If anyone else has any other follow-up questions or anything like that, feel free to hit me with an email. We will collect Ben's slides and have the recording up on our website for you guys to take a peek at. So stay tuned for that. Thanks so much, Ben. Always such a pleasure. Thanks everyone for attending. So awesome to see all these names on here today. So thanks everyone. We'll chat with you soon.
Thanks, Renee.